Today we're doing a complete breakdown of Indian Accounting Standard 115. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying Indian Accounting Standard, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before Indian Accounting Standard 115, companies recognized revenue in wildly different ways, leading to confusion and unpredictability. Imagine two firms, both with $100 million contracts, showing completely different revenues. Indian Accounting Standard 115 standardizes how and when revenue is recognized, bringing clarity and consistency. After this section, you'll grasp why uniformity in revenue reporting matters. Indian Accounting Standard 115 tackled the chaos of inconsistent revenue recognition. Before its introduction, companies had flexibility in timing and method, creating disparities. Aligning with International Financial Reporting Standards 15, it offers a unified framework, crucial for comparable financials. It solves complexities like multiple deliverables and variable consideration, ensuring transparency and consistency in financial reporting. Indian Accounting Standard 115 applies to any entity entering into contracts to deliver goods or services, effective from April 1, 2018. The core requirement? Recognize revenue when control transfers, not simply when cash is received. It's crucial to correctly identify contracts and performance obligations, ensuring revenue matches real-world business activity. The five-step model in Indian Accounting Standard 115 simplifies revenue recognition in plain English. Identify contracts, spot performance obligations, determine transaction prices, allocate those prices, and recognize revenue as obligations are met. This approach ensures financials reflect true economic activity, a crucial insight for finance interviews. It's about precision in recognizing when and how money is truly earned. Scope is crucial in practice. Many candidates forget leases are not covered under Indian Accounting Standard 115. Classic interview trap. Mistakes here can lead to misreporting millions in revenue. Understanding exclusions ensures compliance and accuracy. Always verify if a contract fits within this standard's purview before proceeding with revenue recognition. Indian Accounting Standard 115 governs the recognition of revenue from customer contracts for goods or services. Think retail sales, software licenses, or consulting agreements. If a contract creates enforceable rights and obligations, this standard likely applies. Missing these inclusions can lead to significant revenue misstatements, impacting financial transparency and decision-making. Exclusions are critical to understand. Leases, for instance, are addressed by Indian Accounting Standard 116. Insurance contracts are governed by Indian Accounting Standard 104. Non-monetary exchanges and contracts under financial standards are also outside Indian Accounting Standard 115. Misidentifying these can lead to applying incorrect revenue recognition principles affecting financial statements. A contract under Indian Accounting Standard 115 is a binding agreement with enforceable rights and obligations. Imagine a signed agreement between a consultant and a client. It could be written, oral, or implied. Understanding this definition ensures you're applying the standard correctly, especially in complex scenarios like multi-party agreements or varying jurisdictions. A performance obligation is a promise in a contract to deliver a specific good or service. For instance, a tech company promises a software upgrade as part of a service package. Recognizing these obligations helps allocate transaction prices accurately, ensuring revenue is reported when performance is completed. Navigating edge cases is tricky. Barter transactions might not fall under Indian Accounting Standard 115. Contracts don't need to be written to apply. Oral agreements count too. Loyalty points could be separate contracts if they're distinct obligations. Dealing with non-customer third parties requires careful assessment to determine the applicable standard. Each case demands scrutiny to avoid pitfalls. Struggling to consistently recognize revenue in contracts? The five-step revenue model in Indian Accounting Standard 115 offers a structured approach. Imagine unlocking consistent revenue from a $10 million SaaS contract, ensuring accuracy and compliance. This model unravels complexities and sets a standard for transparent financial reporting. The 5-step revenue model helps businesses recognize revenue consistently. We'll follow Meridian Corporation's $10 million SaaS contract, split into $8 million for software and $2 million for implementation services. This model clarifies how and when revenue should be reported, ensuring transparency and reducing errors. Start by identifying the contract. Meridian Corporation's $10 million SaaS agreement with Acme Incorporated is legally enforceable, with clear rights and payment terms. The biggest pitfall? Overlooking mutual approval of contract terms. Indian accounting standard mandates commercial substance and a high likelihood of payment. This sets the foundation for recognizing revenue accurately. Now, identify performance obligations. For Meridian Corporation, the $10 million contract includes $8 million software and $2 million services. The task is determining if these are distinct obligations. A common error is mistakenly bundling distinct deliverables. Indian accounting standard stipulates evaluating whether goods or services are distinct. Successfully identifying these obligations lays groundwork for accurate revenue allocation. Calculate the transaction price. With Meridian Corporation, the total remains $10 million, focusing on expected consideration. The challenge is accounting for variable considerations such as discounts. Indian accounting standard demands these be estimated and included in the transaction price. This step ensures the financial representation aligns closely with expected cash flows. Allocate the transaction price. Meridian Corporation assigns $8 million to software, $2 million to services, reflecting their standalone prices. The error to avoid is arbitrary allocation, bypassing standalone prices. Indian accounting standard insists on allocation by standalone value, ensuring each obligation's revenue is recognized accurately and fairly. Finally, recognize revenue. For Meridian Corporation, software revenue is recognized upfront, while service revenue follows delivery. A major error is recognizing revenue without obligation fulfillment. Indian accounting standard demands revenue recognition only when control is transferred. This final step ensures financial statements reflect real economic activity, guiding stakeholders with clarity. Measurement choices directly impact your balance sheet. A wrong choice can overstate assets by millions. Companies must choose wisely and disclose thoroughly to maintain transparency. This section unpacks the essential measurement methods and the critical disclosures that Indian Accounting Standard 115 demands. Revenue is recognized upon transfer of control to the customer, as per Indian Accounting Standard 115. This is often when the performance obligation is satisfied, not always when payment is received. The transaction price should reflect adjustments for any significant financing components or variable considerations. This ensures revenue isn't overstated prematurely. Subsequent measurement under Indian Accounting Standard 115 requires vigilance. If transaction price estimates change or performance obligations are modified, remeasurement is necessary. These adjustments are applied to future obligations, ensuring past revenue figures remain untouched. By handling revisions prospectively, companies maintain integrity and avoid retroactive adjustments. Indian Accounting Standard 115 mandates clear presentation. Revenue appears on the profit and loss as revenue from operations. Contract assets and liabilities reflect unbilled revenues and customer advances. Notes should disclose significant judgments and any changes in contract terms to aid investor understanding. Proper classification prevents revenue from being obscured by other income streams. Indian Accounting Standard 115 requires disclosures that enhance transparency. Companies must disaggregate revenue to showcase different streams. Insights into performance obligations help predict future revenue flows. Significant judgments, including contract term changes, must be disclosed to illuminate their impact on revenue. Clarifying any financing components reveals time's influence on transaction prices. Consider a tech firm where the CFO recognizes $10 million revenue upon software delivery, accounting for a $1 million variable component. A price revision triggers a $500,000 adjustment for future obligations. This revenue is listed as revenue from operations, with detailed notes on variable pricing, Disclosures about performance obligations and significant judgments enhance investor understanding of future revenue patterns. Meridian Corporation, a global manufacturing company, enters into a $1,200,000 contract with a European client to deliver specialized equipment over a 2-year period. Discover the accounting journey from contract initiation to completion under Indian Accounting Standard 115. The contract asset represents the right to consideration for satisfied performance obligations. Deferred revenue reflects the obligation to transfer goods. Indian Accounting Standard 115 requires recognizing the contract asset and deferred revenue at the transaction price, showing Meridian's commitment to deliver over time. As Meridian delivers the first half of the equipment, $600,000 is recognized as revenue, according to Indian Accounting Standard 115. This entry reflects successful transfer of control over the goods, reducing deferred revenue and increasing revenue, impacting the income statement positively. Indian Accounting Standard 115 mandates matching costs with associated revenues. Here, $400,000 costs relate to the delivered goods, reducing inventory and recognizing expense. This aligns costs with the $600,000 revenue, ensuring accurate profit measurement. With the final delivery, Meridian recognizes another $600,000 in revenue. This concludes the revenue cycle under Indian Accounting Standard 115, as all performance obligations are complete. The full transaction amount now reflects in revenue, boosting the income statement. Indian Accounting Standard 115 emphasizes matching revenue with expenses. Here, the remaining $400,000 cost reflects the second delivery, fully depleting inventory. This synchronizes with final revenue recognition for consistent profit calculation across the contract's lifecycle. This adjustment accounts for $50,000 in costs incurred but not yet expensed, recorded as a contract cost asset under Indian Accounting Standard 115. These costs will amortize over contract duration, aligning cost recognition with actual benefits, ensuring comprehensive financial statements. Recognition confirms the contract's completion under Indian Accounting Standard 115. The $1,200,000 entries in deferred revenue and contract assets vanish, balancing out. This ensures Meridian's balance sheet now reflects zero outstanding obligations or entitlements from this contract. Every Big Four and investment bank interview on Indian Accounting Standard 115 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. Performance obligations are promises in a contract to transfer goods or services. They exist to identify when revenue should be recognized. Under Indian Accounting Standard 115, each obligation is evaluated separately, ensuring revenue matches delivery. Avoid confusing with delivery milestones. Memorize this. Revenue is recognized when a specific obligation is satisfied. Indian Accounting Standard 115 addresses variable consideration to ensure revenue reflects the expected payment. This includes discounts, rebates, and performance bonuses. It's key for transparency and accuracy. Don't confuse it with fixed pricing. Remember, estimate variable amounts using a probability-weighted or most likely outcome approach. Revenue is recognized over time if the customer simultaneously receives and consumes the benefits. Indian Accounting Standard 115 uses the percentage of completion method to match revenue with project progress. Missteps often happen when focusing on billing rather than performance. Focus on progress, not just contract terms. Revenue is recorded when a performance obligation is satisfied, either over time or at a point in time. For completion, recognize revenue when control transfers to the customer. It's easy to mistake this for delivery. Remember, control, not billing, dictates revenue timing. Indian Accounting Standard 115 mirrors International Financial Reporting Standards 15, with minor differences, mainly in practical expedience. Indian Accounting Standard allows more flexibility in certain disclosures and recognizes expected credit losses. Avoid assuming complete alignment. Key takeaway: similar core principles, but watch for region-specific adaptations. Indian Accounting Standard 115 shifts focus to control, rather than risk and rewards. It introduces a 5-step model, replacing older, more rigid criteria. Misunderstandings arise when old methods persist. Embrace the shift. Criteria now center on specific contract elements and performance obligations. Calculate the transaction price by estimating the amount the entity expects to receive, considering variable consideration and significant financing components. Use a probability-weighted method for accuracy. Many overlook financing impacts, skewing projections. Always adjust for discounts, rebates, and other variable elements. Indian Accounting Standard 115 requires detailed disclosures, including disaggregation of revenue, contract balances, and performance obligations. Companies must explain how they recognize revenue. Omission of these disclosures leads to incomplete financial statements. For success, ensure clarity and completeness in explaining revenue streams and methods. Yes, licenses fall under Indian Accounting Standard 115, as they involve transferring control. Missteps happen when they're seen as standalone, not tied to performance obligations. Key: licenses are part of the broader revenue recognition model, not separate transactions. Variable consideration can skew revenue if not estimated accurately. Indian Accounting Standard 115 requires estimates to match expected payment, yet many confuse it with fixed pricing. Watch for performance bonuses and rebates. Avoiding this trap ensures revenue reflects realistic financial outcomes. Indian Accounting Standard 115 sets the stage for recognizing revenue efficiently. It targets contracts with customers, excluding leases and financial instruments. Revenue is what a business earns from regular operations, while a customer is any party that secures goods or services. Contracts create clear rights, and performance obligations are promises made. The transaction price is the expected consideration from these contracts. Mastering these basics is your foundation for Indian Accounting Standard 115. The 5-step model of Indian Accounting Standard 115 is your compass. Start with identifying contracts that meet certain criteria. Clearly define what you promise to deliver, and set your sights on the transaction price. Allocate this price to each obligation, ensuring revenue recognition aligns with control transfer. Measurement revolves around accurate price allocation, considering variable components too. These steps are your roadmap to mastering revenue recognition. Navigating Indian Accounting Standard 115 in interviews means sidestepping common traps like misidentifying obligations. Remember, while Indian Accounting Standard 115 mirrors International Financial Reporting Standards 15, subtle differences exist. Be prepared to detail comprehensive disclosures. Estimating variable consideration demands precision, and understanding if you're a principal or agent shifts revenue treatment. Don't overlook financing components and contract modifications. Finally, always account for direct fulfillment costs appropriately. These insights could set you apart in interviews. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.